I get, I don't know why I get
Good afternoon, all of you. On behalf of the Professional Development Committee of the Western India
Yes.
Regional Council of the Institute of Cost Accountants of India, I welcome all of you for the webinar series on Guide to Efficient Cost Audit. Today is a part 3, Annexure B1, B2. Our today's speaker, CMA Dushan Dave sir. I welcome sir and welcome all the participants for the third part of the series. Now I request sir to kindly start the session, sir, please.
I'm not able to hear any. Hi, Pujanka. So shall we start?
Yes, sir.
All right, ladies and gentlemen, very good afternoon to everyone. Uh, and thank you for joining our fourth series of webinar. As you are all aware, we started first for audit to advisory, and then now we are getting into individual cost accounting records. Not only how to prepare and how to, but also how to analyze and how to make um, our all cost accounting records very, very useful to the management and to ourselves. Uh, so it's indeed a privilege to interact with all the fellow cost accountants who have gathered here. Whether you are in practice, industry, consultancy, or academics, today's discussion is going to be extremely relevant. As a matter of fact, today's topic is the topic for the cost accounting and the cost audit because these annexes form one of the most important parts of every cost audit report. Sorry. Over the last two sessions of this webinar series, we have understood the framework of cost audit and the philosophy behind Annexure B. So now, before we begin today's session, let's quickly recap what we covered in our previous webinar. That was D3, D4. We explored the key concepts and practical applications related to the topic. We walked through the important workflows and demonstrations, discussed best practices, and addressed common challenges and participant questions. The flow will be similar in these two also. The session provided a strong foundation that will help us build on today's learning. With that refresher in mind, let's move forward to the next set of concepts. I hope everybody had taken part in last webinar, and this webinar is different from that. We are making it very interactive. There will be Q&A in between. We'll be taking part in the various points of the annexures. And our objective is much larger. We will understand why these annexures have been prescribed by the government, what information is required, from where the information should be collected and extracted, and how that information should be verified, what practical issues arise during the audit, how experienced cost auditors resolve these issues, and finally, how to ensure that cost audit report is technically correct and capable of withstanding professional scrutiny. So throughout today's session, I request everyone to think from the perspective of practicing cost auditor in case if you are in practice, and as a person who is maintaining cost audit department in a company, then from his angle of looking at the costing records. So the query should always be that if management gives me this figure, am I satisfied merely because it appears reasonable, or do I have sufficient audit evidence to support it? So that's the essence of cost audit. Throughout today's session, I shall also discuss various practical cases from my professional experience, which will help you relate these concepts to your actual assignments. So let's begin. This the session now, let me just give you a little brief how we are attempting this. This session has been divided into two major technical areas. The first part deals with annexure B1, which is pure quantitative information. And the second part deals with annexure B2, which is the abridged cost statement. It further includes B2A and B2B. So B2, which comes under the B2 and B2B as well, which together explain the cost structure relating to raw materials, utilities. And many professionals assume that these annexures are simply compilation schedules. In reality, they are much more than that. These annexures represent the complete operational story of the company. Think about it. Every manufacturing organization follows a simple cycle. As it is, as you can see the slide, you start by setting up a capacity for a production. You produce out of that capacity. You consume the materials, you consume the utility, and of course, other overheads, and you convert your raw material to the finished goods. And then you sell, and then the profitability or otherwise. I've used profitability, not the profit, because there could be a loss as well. The cost audit report captures this entire cycle. So if any of these figures is incorrect, the entire cost sheet becomes unreliable. That is why part B1 is generally called the quantitative backbone of cost audit. Similarly, B2A represents the material story, while B2B represents the energy story. So as cost auditors, our responsibility is not merely to verify arithmetics. We are expected to understand how operations are functioning. For example, suppose production increases by only 2%, while electricity consumption increases by 18%. Immediately, a professional auditor starts asking questions. Why has power consumption increased? Has a new process been introduced? Is the machinery insufficient? Is there excessive idle running? Has production shifted to another product mix? Is there a wastage? And so on. Similarly, suppose material consumption has increased substantially, but production remains constant. Again, we should not blindly accept management explanations. We should investigate. This is what distinguishes a cost audit from the financial audit. Financial audit asks, is this expenditure genuine? Whereas cost auditor asks, was this expenditure efficient? That's the philosophy behind today's session, and that is also the philosophy behind the theme of my subject, conducting an efficient cost audit. It's going to be interactive questions. My CMA friends, this is a post-lunch session, but I would like to keep everybody awake by asking questions in between. Which annexure do you think generally consume maximum audit time? Is it a B2A, B1? Which one you think consumes the most audit time? Can somebody come with an answer on this, please? When you do the audit of the annexure, which takes the maximum time? B1 or B2? Only received one answer. B2 from Deepak. Anybody else?
Sir, both.
Which is most this webinar for B2, we have to be very, very active, very, very interactive, and we talk together. Which is more consumer, which takes more time? I see senior CMS joining this webinar. Thank you very much for everybody, and please B2, okay.
Sir, both.
See
B1 and B2 both.
Two people coming with a B2. Is anybody to talk about B1? B2 again, Sridhar. Yes. Any more answers?
Sir, both.
All right. Yes, Meherji, you want to say something? Please. Thank you. We welcome Chairman WRC, Mr. Mihir Vyas, to join this webinar. Please carry on, sir.
Sir, welcome you and thanks for your valuable time. Sir, we have very good last two sessions, and I'm audible, sir.
Yes, you are audible. Absolutely.
And you rightly asked the question about the B1 and B2. Both are the hello.
Yes,
Sir, both are
please
prepared
get.
simultaneously, so both are very lengthy information provided by the company. So without B1, we are not preparing B2. So we are simultaneously prepared this both the annexes.
Exactly. Absolutely. You're very right, sir. And thank you for coming into the webinar and giving your points. So all two or three, I mean, B1, B2, and B2 itself consume significant time because each depends upon accurate quantitative data and proper reconciliation. The challenge is not preparation, the challenge is verification. Let me take you there. So now before understanding material consumption, we must first understand what exactly has been produced. So that brings us to annexure B1. Now, let me take you to the slide 3. Today's discussion is divided into 5 logical stages. This is a very exhaustive webinar today, gentlemen. You guys have to be properly glued to our webinar. First, we shall understand the concept of quantitative information. Second, we shall understand where these figures originate inside the organization. Third, we shall learn how these quantities ultimately flow into part B2. Fourth, we shall understand reconciliation techniques. And finally, we shall discuss practical audit issues, red flags, and the methods adopted by the experienced cost auditors. Remember, cost audit is evidence-based. Every quantity reported should be capable of being traced back to some documentary evidence. Now, what are these documents? Those documents could be SAP reports or ERP reports, production registers, daily production reports, stock registers, excise records, GST documents, management certificates, and technical department reports. Professional judgment begins only after documentary evidence has been obtained, not before that. We are not having any judgment whether we need a particular document or not. Document is a must, and then we arrive at our professional judgment. I'll be giving you practical examples on that. Part B1, quantitative information. Now let us understand the volume story behind every product or a service. This is perhaps the most important annexure in the cost audit report. I have made presentation on part B1 to my clients. Why? Because every cost eventually relates to a quantity. Suppose I tell you material cost is 500 crores. Is this good or bad? Nobody can answer. Now suppose I tell you that production quantity is 50 lakh units. Immediately we can calculate material cost per unit. Similarly, labor cost, power cost, factory overhead, conversion cost, profitability, everything depends upon quantity. Therefore, before discussing cost, we must first establish confidence in the quantities. Now, that is precisely why annexure B1 appears before B2. Now, what does B1 capture? It captures physical movement, not monetary values, only quantities. It answers questions such as how much can the company manufacture? How much is it actually manufactured? What was purchased? What was sold? What remained in stocks? What was captively consumed? And what is the capacity utilization? Important principle to note here is this annexure is prepared CETA-wise. Many companies make the mistake of preparing it division-wise or a plant-wise. Now that is incorrect. The cost audit report requires product classification according to CETA or HSN code as we call it now. Therefore, before collecting any quantity, ensure that correct CETA mapping is happening. Now, in the B1, we see the installed capacity. Now, why installed capacity is important? Installed capacity represents the maximum production capability under specified conditions. Many auditors simply accept management figures. That is very dangerous. Installed capacity should normally be supported by the project report, if the company is very, very new, technical certificate, plant engineer certificate, factory license, and capacity enhancement approval in case if the capacity was increased during the year. So whenever there is a capacity change during the year, obtain the documentary evidence. Now, would the capacity change be only positive? No, it could be negative also. You could have sold some plant and machinery and thereby reduce the capacity. So the installed capacity is not something which the accounts department or a costing department of a company gives you. It is something which is certified by the plant manager of a company or a technical department of the company and says that this plant has this much installed capacity. It is like defining the capacity of the room in which you are sitting. Okay. Capacity utilization. Many people think this is merely a percentage. Now, this is one of the most important figure. Actually, it is an operational efficiency indicator. Suppose installed capacity is 100,000 metric tons. Production is 98,000 metric tons. Excellent. Now, suppose installed capacity is 100,000 metric tons. Production is 28,000 metric tons. Now, questions arise. Why it is just at 28%? Why? Is there a market slowdown? Is there a machine breakdown? Was a shutdown in any part of the year? If you remember, in COVID days, we had the capacity utilization in some plants was almost zero. And we had to actually revise our own institute guidelines because of the COVID. Was there a labor issues? Was there a raw material strike? The simple one statement of having a capacity low will actually decide that what went good or bad with the company. This reason should be documented. Sometimes here itself, what can happen is that installed capacity could be 100,000 tons. And suddenly the next year the installed capacity is 120,000 tons. Then you should know that 20,000 tons capacity was increased during the year. And the production of that capacity started at the fag end of the year. In that case, your capacity utilization will come down very, very low because the actual addition in the capacity happened only at the end of the year, which could not reflect the advantages of the additional capacity. Suppose installed capacity is 10 lakh units. Actual production is 7 lakh units. Then capacity utilization is, of course, 70%. But the next year, suppose production is 7 lakh units. Installed capacity increases to 15 lakh units. Then capacity utilization becomes only 47%. So the auditor should ask that what additional machinery has been installed, has commercial production started, were trial runs completed, was depreciation charged, were fixed overheads underabsorbed. This is how the cost audit adds value. The capacity is nothing but incurrence of the fixed cost. And it's while we talk everything about the raw material, power, utility, this is one of the fundamental thing that you started incurring the cost the moment which you started installing the production capacities. Now, if there is no production happening out of that capacity, your fixed costs remain underabsorbed. Let me ask you, bring you here, Rob, you in here. Can installed capacity ever reduce? Can somebody just say yes or no? Can the installed capacity ever reduce? I did hint at answer earlier, but can yeah, Deepak, yes, Jyoti, yes. Any more people? Can installed capacity ever reduce? The capacity is fully installed. Yeah. Okay. Except one answer, everybody has said yes. Yeah, answer is yes, friends. For a simple reason is that so what do we actually mean by installed capacity is that you set up machineries, and machineries have the capacity to produce. Now, if you take out some machineries for the wear, tear, or for whatever reason for obsolescence, in that case, your installed capacity comes down. You have to rework out the installed capacity and show it in the annexures. Because if you don't do that, and installed capacity remains as earlier, then all the time your actual production, which will be always showing underutilization, it will be showing that there is there is a less utilization of the machinery. There could be environmental restrictions on which good machineries have to be disposed of. There could be closure of production line. Now, here again, when you close a production line and keep the machinery, may not sell the machinery, but keep the machinery idle, then actually what you have done is that your installed capacity has come down. And when your actual production is happening, your percentage utilization should show a correct picture and not deflated figure. There could be government restrictions on manufacturing certain products. And of course, the technological obsolescence, we are saying more in the IT sector that your all servers, computers can be outdated within 1 year's time, and you might have to even write off everything. Now, let us understand where every figure appearing in B1 originate from. This is very important because we should be knowing while B1 is it's an outcome of the data, where the B1 is coming it from. How do you pick up various figures in B1? Every quantity disclosed in B1 serves multiple purposes. For example, production quantity is used for cost per unit, inventory valuation, capacity utilization, material consumption analysis, utility consumption analysis, cost variances, productivity analysis. Therefore, if production quantity itself is incorrect, every subsequent analysis becomes incorrect and misleading. Similarly, stock reconciliation acts as a powerful audit tool as well. Now, as I mentioned about opening stock, production, sales. Now, production minus sales minus captive consumption will become the closing stock. And if this equation does not match, then there is either incorrect reporting, missing transactions, wrong classifications, or ERP errors. I am mentioning that again on the slide as well, that part B1 is the quantitative backbone of the annexure prepared by CTA wise. It captures physical volumes, not values for each product or services covered under the cost audit. And you probably you can take a screenshot of this as well. So never ignore reconciliation differences because this is your base on which you are going to do the costing later on. Small differences often relieve much larger underlying issues because small differences could be compensating errors, and there could be a big differences lying on that. Now, why part B1 matters for cost audit? If you look at the screen, which I have produced the entire logic of why B1 matters, it validates capacity claims. Okay, so the moment you have prepared the B1, it validates the capacity claims. It flags abnormal utilization. So if the utilization is more or less, you will find some companies having actually 110% utilization. It need not be that always it's underutilization. So it give you the characteristic of the company's production, company's nature of industry. It anchors the cost sheet. See, what I mean by anchoring the cost sheet is that how the cost sheet, what is the basis of a cost sheet? Nothing but a production. Opening stock, production minus sales, closing stock is actually the quantity which will become a basis for arriving at a cost per unit. That's a denominator. The denominator for the entire cost sheet is nothing but the production quantity. It also, let's say it tests the stock integrity in a way that if the stock is right, this will come out of it. It supports reconciliation because when you do the reconciliation of the quantity for you with the GST returns, annual returns, and all, this will be supporting this stock reconciliation as well. And it's also a basis for auditor's opinion. Materially wrong volumes, or you can have a fair opinion about the. So this part B1 is very, very important. Now, what we will do is, having established the logic, philosophy, and everything behind part B1 and why it is important, let us go to the actual aspect of preparing a B1. Where do you take each and every line item from? So I have reproduced pro forma B1 on the screen, as you can see. And I've also reproduced on the left-hand side where do you pick up each line item from? You might like to, the new CMAs might like to take a screenshot of this as well. Let's start, I've put the headline already that product should be HSN code wise. Okay, now I'm using CETA code and HSN code interchangeably, but CETA code doesn't exist anymore. Just for your information, CETA full form is Central Excise Tariff, and since we have done away with the excise, what we are now, all CETA codes is replaced with the HSN code. So we have been using CETA code for many years, 30 years, and it has remained in our language, but we should use the terminology as SSN code. So my B1 pro forma is HSN code wise, name of product, HSN code, and the unit of measurement. It could be kgs, liters. In case of a pharmaceutical company, it could be number of vials and so on and so forth. So let's start with the first one. The installed capacity at the beginning of the year. Capacity which was been enhanced during the year, and capacity available during this entire, the arrangement of it. And capacity, so where to pick up this from? Installed capacity. As I said earlier, you have to look at a factory license and OEM documents. When the factory was started, factory was licensed to give certain amount of capacity which a company can produce. As you are aware, of course, the license Raj doesn't is not anymore there, but some of the quantities, yes, there is a license. So you just cannot increase the install capacity. And install capacity, based on that only, the economy takes the major decisions at a higher level, that how many capacities you are installing for a particular product and what is the demand supply gap. And accordingly, you decide about the install capacity at a macro level. And then at a micro level, at an individual company level, you should be able to produce only that much which is available in the factory license. How will you pick up capacity enhanced during the year? Is it by just because management costing department told you that we increased by 10,000 tons? No. Please take again certificate from plant or management approval that this capacity was enhanced for this particular thing. Get the details, make it part of your audit papers. Capacity available through leasing arrangements. Now, we have number of products more in case of a pharmaceutical, or for that matter, many companies in FMCG and all. They lease out. They don't set up their own factory. They will do the contracting, and then in that case, you have a capacity available, yes, but not in your own plant, but outside your plant. And for that, there is a lease agreement, and you can ask for a copy of a lease agreement. Capacity available through loan license and third parties, again, job work agreement, where you may not lease out the plant. You simply provide them the raw material and they do the job work, they add the value to it and return to you. Then the only cost which you incurred is the job work charges. Rest of the utility overheads are incurred by the third party. So, and the total available capacity will be, obviously, it is total of A to D. That makes your total available capacity. Now, having defined the capacities, see, this itself, as you can understand, this also is very important figures to arrive at and to know by the cost auditor, so that he can understand where the company comes from. Then we go to the actual production. The self-manufactured is the next. So where do you get the self-manufactured production from? SAP records. And you can do again a little test check on SAP records, where SAP records get it from. SAP records is also something which is derived out of some original document. And what is the original document? Is the production report which happened in the factory. So daily when there is a production happening, there is a production report. And now currently, if the company is fully integrated SAP system, then the entire production is recorded in the SAP itself. Then under leasing arrangements, as I said, it's a lease agreement, but then there will be separate documents available for the dispatch coming out of the leased factory. On loan license, by third parties on job work. Again, you'll have a job work records. Remember that whatever comes inside the factory and goes outside the factory is always recorded, and you'll be able to lay your hands on all the records which has brought the goods inside. And the total production is, of course, a total of A, B, and C. That makes your total production as this thing. Now, I'll give you a couple of notes on that. On install capacity, we already mentioned that you should go to the source document. Source documents are factory license to start with. For addition deletions, there are engineering department, technical head, project manager. For capacity enhancement, again, you will have a capitalization data of machinery, date of installation, commercial production date, and technical certificate date. These all four figures are important because date of installation, and from date of installation to actual commercial production date, there could be a gap, and it will reflect in your capacity utilization percentage, and it might give a misleading picture if it is not correctly disclosed. Merely purchasing machinery does not mean capacity has increased. It should have been put to use. Capacity through leasing nowadays, as I said, you can go not only in lease agreement, but what is the production responsibilities, what is the period of lease, what is the quantity produced, etc. also becomes an important information for you. Job work data which you are collecting, you can, I told you, you have to go to the source document. Every company has a records. So what is a code? GRN, job work register, GST job work challenge, material issue records. These are the records which will confirm your production figures. This could become part of your audit working papers. Production should never be verified from only one report. Cross-verify this production report with SAP, daily production reports, shift reports, quality reports, production summary, and your GST records wherever applicable. So in short, what we are trying to drive a point is that any number which is given to you has to be a evidence. There has to be a source document which says that yes, this is the figure which has come from there. In that process, you will also understand the entire manufacturing process of the company. So never accept manually prepared Excel summaries because there is a costing department of your client company probably could be giving these numbers readily. You have to ask that what is the system generated source, because Excel can always be modified. ERP audit trail in that case it should be relied upon, and it is a much stronger trail. As a matter of fact, with current, most of the companies having great ERP systems and SAP systems, I think you need not rely on any kind of an Excel data at all. Let me tell you one practical example out of my own experience. The production is 50,000 tons. SAP showed 49,200. There is a gap of 800 tons. And management says that, sir, this is only adjustment. Now, after verification, we found that job work production had been omitted. Now, that single correction affected material consumption, utility cost, capacity utilization, finished goods, and cost per unit. So one quantity affected almost the entire cost audit report. So there is no scope for any oral or a Excel explanation to our audit. There has to be a written evidence for everything. Let me pause for a second and ask you a question. If SAP data and production register differ, which should be accepted? A very important question. We come across this very often. If SAP data and production register differ, which should be prepared? Which should be accepted? The SAP or the production register? Anybody here? If SAP and production register differ, what do you take? Yes, Sanjeev, production register. Any more people? More opinions, please. SAP is sacrosanct. SAP HANA we have put the latest systems in log, and most of the time we are given this, but you also ended up being a very efficient cost auditor getting into the production register, and you find that the data in production register is different from SAP. What should be the correct one? Let's make it interactive, friends. And this is very important. If you find production register and SAP, yeah, but Ravindra, we don't want to get into Ramkishan that why. I'm just asking if between the two, which is the most, which is the correct one. That's a good answer, Sanjeev. Production register is a root level source. So I think that's a correct, very, very well defined. It is something which is, I would not have used such a very good words. So the production register is origin. See, if you remember, I talked earlier that the behind SAP records also there is a production voucher production happen, daily production report, and from daily production report, production register is done. Now, if somebody has made an error in entering that particular, suppose SAP is not gone down to the product plant wise at a plant level, then there will be an error. So this basically, so we should always accept, though there could be, okay, I mean, there could be a conclusive answer, but you can also investigate here, understand the reason, also obtain documentary evidence. Here is where probably we'll have a professional judgment that production register is always a source document, but why there was a difference? Was it simply a typing error by the person who entered into SAP? Or was it something else? I know that's where your professional judgment will come into picture. So now that we understand where quantities originate, now as you see, we have already now learned the complete B1, where you are ready to now prepare any B1 of any company, any industry. And now that we understand where quantities originate, the next part of the session will explain how these quantities are converted into meaningful audit evidence, how reconciliation is performed, and how it leads to B2 and B2B out of this quantitative foundation. So now let us go to line items continuation. So where to trace from? So in the we discussed install capacity and production. I'm now going below the productions. I'm going into the further line items. Let us say production as per GST records. Once production has been verified, the next step is to ensure that all quantitative movements are also properly accounted for. Now remember, cost audit is not limited to production alone. We must account for every movement of finished goods until they are either sold, consumed internally, or remain in stock. Let us understand each item. Now, there is a line item in our pro forma B1 called production as per GST records. I'm not speaking excise, though it is showing in the format. The GST, although the GST regime has replaced central excise for most industries, certain sectors continue to maintain excise records. Even where excise is not applicable, companies often maintain statutory production registers. So these records serve as an independent verification source. So if production quantities differ between SAP and statutory records, do not ignore the variance, understand the reason, and it may be due to timing differences, production recorded but quality is rejected, trial production, and data extraction errors. So we only looked at the data extraction errors, but the other three important reasons are timing differences, production recorded but quality was rejected, trial production. So that put the SAP as a correct figure than the production register. So this is how the things change. Capacity utilization is, and the next point, item number 4 is capacity utilization in-house. So self-manufactured install capacity into 100 is basically, so your actual in-house production divided by install capacity is your percentage capacity utilization. So many professionals calculate the percentage correctly, but never analyze its implication. As I mentioned, the B1 itself, your capacity utilization numbers itself can make a case for your presentation to the management about how analytical this B1 can be. So capacity utilization tells us, is the plant operating efficiently? Are fixed costs being absorbed properly? Is there excess idle capacity? Is the company over-invested in plant and machinery? A low utilization percentage often results in higher per unit fixed cost. As a matter of fact, this statement itself will give you, you don't even have to go to cost sheet if you want to just comment on the type of the level at which company operates. If it is working at a low capacity utilization, you already know that the company is into serious problem. Then the next item is finished goods purchased. See, everything doesn't get produced in the companies. So many companies sell products which they have not manufactured at all. This may be traded goods. So what happens is that the company is manufacturing a finished goods up to an extent, but then it still has a lot of market for its own products and it cannot manufacture. So it will buy and then it will sell it. So because it's already there in the market about those products. Then outsource products, you're outsourcing the production activity, then the contract manufacturing again. Those who are working in pharma, you're very much aware about this contract manufacturing. And then the imported finished goods. So this is how the company sources, that how the products are, though not manufactured, but for sourced from outside. So always ensure that manufactured goods and traded goods are reported separately. Otherwise, production analysis becomes distorted. And then the next is stock and other adjustments. The stock movement schedule, which is also again very important. The opening stock, closing stock, captive consumption, samples, wastages. Now, captive consumption here deserves particular attention. For example, a chemical company may manufacture sulfuric acid for internal consumption. Although no external sale takes place, production has occurred and must be reported. So captive consumption of a product which is produced becomes part of the production records. So whenever stock adjustments appear unusually high, so as a matter of fact, this again is as important as the production quantity. So any kind of a stock adjustment, please ask management that why was the adjustment necessary? Is it due to quality rejection? Is it due to stock write-off? Or has physical verification revealed shortages? Document this explanation and make sure that these aspects of stock adjustments are very well covered by the financial auditor as well. You should be knowing that while the physical stock checking takes place on a sample basis, the stock valuation per se never gets audited by the financial auditor as well. Now, can negative stock ever appear in SAP? Let me ask you a question here to rope you back in case if I have lost you somewhere. Simple question. Can a negative stock ever appear in SAP? Can we have a negative stock? Stock, right? A stock is opening stock, production minus closing stock. So it's a consumption. But can there ever be a negative stock? Correct? No? Yes, Sanjeev? Yeah. Some have answered no. Anybody wants to, can there be a negative? Yeah. Right. So not in SAP. Okay. Inventory should not be negative. Correct. So in the SAP system, so a good sold on sell or return basis. Good answer, Deepak. Yeah. In Tally, it is common, Shankar. Okay. Well, that is dangerous. Okay. So most of the people have answered no is correct, but technically you are right. Depending, but sometimes in the system configuration, you might get a negative answer. It's a big warning signal requiring further investigation. If at all you ever come across a negative stock in SAP, My question was whether it appears in SAP. I have not said whether physically. The stock can never be negative physically. But in SAP, if it appears negative, as somebody said in Tele, it is common, then it's a warning signal, and we have to go much deep dive into this SAP records, that how come it gave us a negative figure. Now let us understand see the other examples. Reason happens sometimes there is a captive consumption, and it's not accounted properly, so it shows negative, but actually the material, instead of getting into the stock, it was captively consumed, but it has not been captured well into SAP. So you get a negative thing. Now let us understand the final reconciliation of quantities before we move into material consumption. Yes, Sankar, you're right. Sometimes code gets interchanged, and that also happens. So again, physically there was no negative stock. It went into SAP records, and it gets into deep dive, and we can come out with some surprising results. Now, how do we reconcile the quantities before we move into material consumption? As you can see on the slide, total available quantity for cells, so we have written it's 2D plus 5C plus 6D is the total quantity available for cell. So therefore, total cells are deducted. The balance should represent closing stock. Although the formula appears simple, practical issues arise very frequently. For example, a company may manufacture product A and subsequently convert it into product B. If such conversion is not properly recorded, quantitative reconciliation becomes difficult. Similarly, samples distributed free of cost must still be considered. Many companies forget to include these quantities. And remember, physical movement is important, very important. Whether or not revenue has been recognized is irrelevant. So while you are doing a quantity, please don't confuse it with whether it was a sales or not sales or regular sales. Just focus only on quantity tally. So it's like, for that matter, our entire costing, all annexures, when you prepare one annexures, don't confuse that you're going to again look at it in the second annexure. Each annexure is independent statement on its own. And the way in which it has been structured, as I told you, from B1 to B2 is that B1 production will lead to B2. But when you make a B2, you're only focusing on a B2. You are not trying to get into the B1 figure, which has been picked up from the B1. So when you are making a B1, please only focus on the quantity. Let me give you a practical example, actually. So say let's say production is 100,000 units, purchased is 10,000 units. So opening stock was 5,000. So total available is 10,000 plus 5,000 opening stock, and production is 100,000. So you have a total available is 115,000 units. And out of 115,000 units, you did a sale of 90,000 units. And then you did a captive consumption of 3,000 units. So closing stock should be 115,000 units minus sales of 90,000 units minus captive consumption of 3,000 units. So closing stock should be 22,000 units. Now, if SAP shows 21,400 units, the difference of 600 units cannot be simply ignored. So you'll have to every quantity then will require the explanation. Once quantitative reconciliation is complete, we move to one of the most practical aspects of cost audit, verification through SAP. So one important point auditors should keep in mind is that the capacity utilization can sometimes exceed 100%, which I mentioned earlier. And this is not necessarily an exception. Whenever this happens, the auditor should understand the reason rather than assume the figures are incorrect. So you just can't come to a conclusion, okay, come on, capacity is 100, you can't make 120%, 110%. Let's get into that. I'll explain you with the practical example as well. So what are the common reasons for this? Process improvement leading to higher efficiency. You from the same plant capacity, you ended up manufacturing more by some process improvement, and you ended up so that's a better utilization of the machinery. It's not an incorrect figure. Similarly, automation or technological upgrades which happen, which you don't capture in the installed capacity. Installed capacity remains same, but some change in the technology has changed the capacity. Better yield with the reduced wastage. I'll also give you an answer to that, how can we not formalize this? Better yield with the reduced wastage is also another reason. Then additional shifts or extended working hours. Removal of production bottlenecks. For example, in your own office, if you're working for 8 hours, tomorrow you start working for 16 hours. Your same office of 1,000, 2,000 square feet will be giving you a higher yield. So, but your capacity of the office is same. The removal of production bottlenecks could be the one reason. And install capacity being very old and never revised. Now that's the key. Even though actual production capability has increased over the years. So installed capacity, let us say I set up a factory 25 years before. And then I went on doing the process changes, improvement, my material movement and all. So the assumptions on which installed capacity was licensed, rated, and given you a certificate, that assumptions are no more valid. Even the product configuration could have changed. In that case, we have to revise the install capacity at a periodical interval. It's a good idea to do an audit of the install capacity itself. If the cost auditor is assigned this aspect, he should very well do it along with the assistance of the technical person and revise and set right adjust the capacity to the correct capacity so that you don't show underutilization or the overutilization. What questions we can ask in such situation? Okay, how was the install capacity determined and when was it last reviewed? Why the production has exceeded the available capacity? Were there any process improvement, tech upgrades, additional shift during the year? Has the company considered revisiting its install capacity based on current manufacturing capabilities? Can management provide supporting documentation or a technical explanation for the higher production? So the key takeaway here is that capacity utilization above 100% is not automatically an audit issue. It should prompt further inquiry, and if management explanation is reasonable and supported by evidence, the disclosure can still be considered as an appropriate disclosure. And the overutilization is also very well justified. Now, where do we verify these SAP movement types? Today, almost every medium and large manufacturing company operates on an ERP system. SAP is, one of the system. ERP could be having many systems. SAP is one, Oracle is another, and so on and so forth. SAP remains, of course, the most widely used ERP system. As cost auditors, we are not expected to become SAP consultants. I'm not advising here that you understand SAP fully and then the whole architecture of it, though it could be a separate practice area altogether. However, we should know where audit evidence originates. Movement types in SAP represent different inventory transactions. For example, goods receipt, goods issue. I've given you a whole list of SAP movement type on the screen. Again, you can take a screenshot of this. Production receipt, transfer posting, stock adjustment. Each movement type has a unique code. We have put this code as well. These codes provide an audit trail. So instead of relying on manually prepared summaries, request system-generated reports. Always reconcile SAP reports with stores ledger, production register, trial balance, and financial statements. Whenever management exports SAP data into Excel, request both original SAP report and Excel working, which is I've heard that management says this is what I'm giving you is SAP extract. Please accept it for your cost audit, and we should say yes, thank you very much for this. But we also like to have an original SAP report, which again reinforces my earlier pitch to all of you that all our papers have to have an audit evidence. We are not taking the numbers as it is. We are supporting it with the audit evidence. This helps ensure that no data has been filtered or modified. Now, let me ask you one question here. Should cost auditors verify every SAP transaction? Should cost auditors are under any obligation to verify every SAP transaction? Any answer? Should the cost auditor verify every SAP transaction? Yes or no?
No.
Padmaja says yes. Jyoti says no. Prashant says no. Vishesh says no. Ritik says no. Only sample can be checked. Prashant says. Rin says no. All right. Answer is, of course, no, gentlemen. Audit is based on risk assessment and sampling. Our material transaction should, in case of a very, very material transaction, if you see a very, very large transaction, you can do a test checking. Now, let us summarize everything which we discussed under B1 before we go to B2. Okay. So, as you know, my last 3-4 webinars, my style is that we speak a lot, and then for the people who joined little late, we'll do a little key takeaways. I put it on the screen again. Let us recap the key principles. Remember these 5 golden rules. Rule 1 is always prepare B1 on a CETA or HSM code basis. Never prepare company-wise figures. Rule 2, every quantity should originate from authentic source documents we discussed in detail. Rule 3 is production, stock, sales, and captive consumption must reconcile. No compromise in this. Rule 4, do not ignore abnormal capacity utilization. It could be more or less. Investigate the business reason. Management is under obligation to give you an explanation for any change in the capacity utilization. It may be normal or abnormal. You have a right to ask because it relates with your fixed cost absorption. And any major change straight away affects your capacity utilization and the fixed cost. Rule 5, a weak B1 meaning when an inefficient B1 or a faulty B1 inevitably produces a weak cost audit report or rather misleading cost audit report. If quantities are wrong, every subsequent cost calculation becomes unreliable. This completes my part B1. You can take a screenshot of this as also very, very important. Put it on your cost audit document when you do it, your manual. Do it yourself, give it to your assistants to follow this whenever you're doing a B1 cost audit. Now, we move to part B2A. So we have taken pretty good 1 long hour on B1. Probably I'll be taking little more than that in B2. And be please mentally prepared for that because B2 is our forte. B2 is what cost accountant has been appointed for. B2 is what a cost accountant does, a cost accounting system does. And B2 is what the entire profession stands for. B2 is nothing but a product P&L account, which nobody prepares other than the cost accountant. So this is one of the most important schedule in the entire cost audit report. Every manufacturing organization exists because it converts raw material into finished goods. Therefore, the first question every cost auditor should ask is, has the raw material consumption been measured correctly? Notice that I am not asking whether the accounting entry is correct. I am asking whether the actual consumption is correct. That's the difference between the financial audit and cost audit. The financial auditor would have vouched for all accounting entries. We assume that, and we don't challenge that assumption. Accounting entries we take as it is. We are not supposed to go into the audit of those accounting entries. We are getting into the actual raw material consumption for the product. So what is the objective of B2A? I need water, if you can tell me. B2A answers several important questions. Which materials are consumed? In what quantity? See, I'll tell you overall philosophy, then I will go into the actual B2A pro forma as well. So B2A answers in questions like material consumed in what quantity, what value, from where they procured, whether they imported or indigenous, whether self-manufactured, is the consumption reasonable? Why reasonable? Even that also will come into discussion. Now, why this schedule is critical? In many industries, material cost represents 50 to 80% of total manufacturing cost. Rarely you will find 50%. Most of them are working on 75-80%. Therefore, even a small error in material consumption can significantly affect your product cost, your inventory valuation, profitability, your cost competitiveness, all four very important. So what should an auditor verify? So we do not merely verify the totals, verify every important attribute. For example, is the material description correct? Is the unit of measurement consistent? Is quantity supported by SAP? Has the valuation method remained consistent? Is the material mapped to the correct product? Let me give you a practical example here again. Suppose, steel is one of the major factory where the cost audit is so much prevalent. Steel sheets are consumed for manufacturing electrical panels, let us say. Management accidentally maps them under the another product. So production quantity may appear correct. Financial accounts may also remain correct. However, product-wise cost becomes completely distorted. This affects your pricing decision. Hence, correct product mapping is equally important. Unit of measurement again. Never underestimate this unit of measurement verification. 1 year the company reports kilograms. Next year metric tons. Unless proper conversion is applied, trend analysis becomes meaningless. Input-output ratio also comes out of this. One of the strongest analytical tools available to cost auditor is suppose last year 1.1 kg of steel product is produced per unit. This year 1.40 kg is good. Immediately investigate. If 1.10 to 1.40 is nearly 30% change. Possible reasons: design change, increased scrap, quality issues, process loss, wrong bill of materials, recording error. So never accept any abnormal consumption without the supporting evidence. How do we reconcile? Always reconcile material consumption with the cost records, trial balance, financial statements, and of course, we are talking about CRA 3. So all four should agree. Let me bring you people here again. If financial accounts and cost records differ, okay, very important question which must be facing all practicing people. If financial accounts and cost records differ, which figure should be reported? If the financial figures and cost records are differ, then which figures should be reported? And dear CMA friends,
Sir, of course,
are we
we should.
saying cost records because we are all cost accountants? Why you saying if both are differ, why cost records or why financial account? Which figure should be? Let us only confine to that. Anybody has that opinion that it should be financial record? Yes, correct answer. Shraddha, thank you. More answers, please. Has anybody got any definite answer? Okay, I think we can't accept any one statement blindly. Understand the reason for reconciliation. I agree. Yes, Sanjay Kumar, this is right. We have to reconcile the record. Only after reconciliation should the correct figure be. As a matter of fact, the moment there is a difference, you have all the right to deep dive into everything. And you'll be coming out with the surprises, which even you will be finding that management was not aware about. Now, let us understand every field appearing in a B2H schedule. Now, I am getting into the B2H schedule. Now, this I put a B2A on the right hand side, the proforma, and the left hand side, I'm again giving you the notes how it comes from. Now, this slide may appear to be a simple table. In reality, this is a checklist that every cost auditor should mentally follow while auditing raw material. Let us discuss every field individually. Remember, I am on B2A, not on the B2. Okay. B2, we are going to come out little later on, and you will be wondering that why I'm skipping B2. I'm not skipping B2. I'm first getting into the B2A, and then we will go to the B2 again. So the B2A is one of the, as I said, it's the 75-80% of the cost of the product. And here is a table which I put it on the screen. Let us discuss every field individually. So materials are classified as indigenous, imported, and self-manufactured. So each category has a different valuation implications. Imported materials require verification of what? Customs duty, freight, insurance, exchange rate. Self-manufactured materials require verification under our cash for principles. Quantity part, in case of a raw material consumption, never accept quantity without any audit evidence again. Sources should include what should be the sources. Now I think we are all getting together, aligned on this. SAP consumption report, stores ledger, material issue slips, production records, bill of materials, cost records. So these are your sources for material quantity. Again, unit of measurement becomes essential here. It should be consistently used. If you're using kg, let it be kg. You must be very well aware that natural gas, for example, may be measured in in SCM, while LPG is measured in kilograms. So ensure consistencies throughout the report. One of the strongest analytical review procedure is that if the expected consumption is 10 tons and actual consumption is say 11.8 tons, difference is 18%. Now you can ask, was there any abnormal loss? Was there process modification? Was production rejected? Were quality issue identified? All these issues will come out from your input-output ratio. Here is your raw material is IO ratio comes out here. The way in which you had a capacity utilization percentage, now you are talking about in a way, raw material consumption utilization percentage. The efficiency shows from this particular table. A surprisingly common error is that material should always be mapped to the correct product. Wrong mapping, basically affects your product cost, segment reporting, and cost competitiveness. And the material description should be, again, there has to be consistency in material description in SAP, stores ledger, cost records, everything should be maintaining the same material description. You can't have a different kind of a description in every material. Otherwise, duplicate reporting or omission may be occurring. So that goes without saying for each and every item of the cost as the description part of it. And most of the time we waste our time in telling because the products has been described differently in a different source document. And similarly, let's look at the average rate per unit, which is there in the slide. You can see that. Compare this with the previous year, purchase trend and market prices. If market prices are stable, but reported average rate increases sharply, then definitely you must investigate. I'll just cite one practical case studies here especially for a rate per unit. A pharmaceutical company, for example, reported material consumption increased by 20%. Production increased by only 3%. So the investigation revealed that expired raw material had been written off during the year. So actually there was no extra raw material consumption. The ratio, input, output, everything was fine. But your expired raw material had been written off and it was shown under the raw material consumption. So it showed suddenly that material consumption increased by 20%. So without understanding the reason, one could incorrectly conclude that manufacturing efficiency had deteriorated greatly. So again, professional judgment is therefore very essential. The moment you find any kind of a red flag, which we have a topic on a red flag in the coming slides. So what kind of questions you can ask to the management on the B2A? Has any new material been introduced? Has any material been discontinued? Has BOM changed? See, the change of BOM is not a regular event in a company's history. BOM doesn't change frequently because you decide a product recipe, bill of materials decided by the engineers, it is frozen. Unless there is a drastic change in the recipe of a product, you don't change the BOM. So when the BOM changes, it's a big event in a manufacturing production line of a company. Is there a change in suppliers? Has the valuation policy changed? Because the valuation policy, it could be FIFO, LIFO, weighted average. And if you change any kind of a valuation policy, I mean, into the stock valuation policy, then it will again affect the numbers. Have import duties changed? These are the questions often relieve important audit observations and also will increase your own knowledge about the industry and the company. Let me pause here and ask you one question. Is every material required to be disclosed separately? Since we are preparing B2A and material, can somebody answer? Is yes or no? Is every material required to be disclosed separately? Every material? Yes and no, I got both the answers. So is it required? Is every material required to be disclosed separately? Only top 9 and remaining in 10. Only 10. Major direct material. Major direct. No. Any more answers? Then I'll pick up the last answer as the correct answer. No. Only materials exceeding the no, not all. I tell you reason because there could be hundreds of materials. So only materials exceeding the prescribed materiality threshold. You decide the materiality threshold should be disclosed individually. Others may be grouped appropriately. However, the auditor should independently verify the materiality calculations because that's again your professional judgment. I cannot give you a formula that this is materiality. Say, for example, there are 3 materials only, and one is having a 70% consumption, another is having a 20, another is 10. I would say put all 3 because there are only 3 materials and all are material. But if one material is 50 and other 300 or 200 or 20 materials are there, then you have to use your judgment which had a measure materiality was how many materials. So now that we understand the structure of B2A, so gentlemen, to revive again, we understood the B2A again, not B2. B2A is a material. Why we took it first? Because it is 70 to 80% of the cost. We talked about its stocks, quantity, tally, how you pick it up, source of data, and so on and so forth, and input-output ratio. So now that we understand this structure, the next session we will be focusing on classification, reconciliation, practical audit errors, red flags, and utility consumption. That will be B2B. So these areas are where experienced cost auditors add the greatest professional value. Now that we understand the structure of annexure B2A, let us discuss how materials should actually be classified. Many audit observations arise not because the quantity or value is incorrect, but because the material has been classified under the wrong category. Classification is extremely important because management, regulators, and users of the cost audit report analyze the cost structure based on these classifications. Therefore, the auditor should understand not only what has been consumed, but also how it has been reported. The first classification is based on the nature of the material. So these include what are the nature of the material? Raw materials, stores, spare parts, tools, jigs, fixtures. The various types of material which goes into the production. Now, one common mistake seen in practice is that consumable stores are reported as raw materials. So here where you have to be careful. Your entire ratio will go haywire. Lubricants used for maintaining machinery are often incorrectly included in the raw materials. So this is considered as a wrong classification. And it will add to the raw material cost unnecessarily, whereas it was actually a consumable stores. And secondly, you can also classify by traceability. say every material should be classified as either direct or indirect material. So direct materials can be classified, identified with a specific product, whereas indirect materials support production, but cannot be conveniently traced to a single product. So consumable stores is one example. Like cleaning chemicals, machine lubricants, maintenance consumables. So proper classification improves cost allocation accuracy. I just read a remark that in the financial statements, they are classified wrongly. Our duty is to get it corrected. Classification by source also you can find out that material should be, whether it is indigenous, imported, self-manufactured, and then imported materials should usually include customs duty, ocean freight, insurance, port charges. So these components affect the landed cost. Self-manufactured materials require valuation based on cost accounting standards, not on market price. Please remember it very well. CAS 1 to 25 are our main guiding principles about the our cost accounting standards. Please follow it religiously. Each of the standard has been prepared after a tremendous amount of discussion and due diligence. And a lot of experts' opinion has been taken before we the institute froze the standards. One of the most important disclosure requirement is that any material contributing 5% or more of the total material cost should normally be disclosed separately. So, which I talked about earlier, the materiality part. So, do not rely solely on the management's grouping. Independently recompute the percentages. Sometimes large materials are intentionally grouped under others to simplify reporting. This is exactly what other gentlemen remarked that financial records sometimes misreport, but we can ask for the details and correct it ourselves. Let me give you a practical example. Suppose total material consumption is 100 crores. Out of that, I'm giving you a little more detail. Let us say copper wire is 6 crores. Okay. Steel is 38 crores. Plastic granules is another 4 crores. So only steel and copper here. So again, repeating, 100 crores is the total material consumption. Copper wires is 6 crores. Steel is 38 crores. And granules is 4 crore. So only steel and copper exceed the 5% threshold. Okay. You can skip the other one. Whereas the plastic granules may remain under the others. So always perform this calculation independently. It will give you a lot of insights and it will correct the misreporting which has happened in the financial system. At this point, you please understand the authority and the power which as a cost auditor you have to get into the details. It will give you a lot of insight. Can packing material be, now let me ask you here, again drop you here in. Can we consider packing material under raw materials? Can we consider packing material under raw materials? Can somebody say yes or no? No? Can somebody say? Correct. Okay. So I think everybody is expert. So Mr. Sridhar said yes. Okay. Are there any more yes in the audience? Can packing material be? Vipin Patel says yes. Any more people who is agreeing that packing material is part of a raw material? Okay. Since let me, I would have loved to receive everybody's answer on this particular matter, but let me go to my own guidance here, which all CMS should have only one guidance: cost accounting standards. Okay, packing material is separately dealt with under the relevant cost accounting standards, unless, as somebody said, no had also had a reason probably, unless it forms an inseparable part of the finished product. The product is such that the product just cannot hold unless it is given. You can't have a liquid holding in anything. You have to have some material along with it. The drum has to go along with the lubricant, for example. So in that case, you are considering as a part of the exactly, Siddharth. That's what you meant. I understand that. Now let us understand how all these quantities and values should reconcile. Having discussed all this, let me put you a very important analytical slide which we have prepared, that how all these quantities and value reconcile. So how to prepare annexure 1A, B2A again? You will be surprised the length at which I am going for this B2A. Step 1 is the SAP extract. Step 2, so I don't have to say anything about SAP extractions. I've given you in the code. Please take a screenshot of this. It's very important. It will be useful to you on a daily basis. Step 2 is filter the SAP extract for the specific product being reported in B2A. Use plant plus material group plus production order to isolate consumption for that product only. Step 3, sort all materials by amount. See top 10 rule, So select the top 10 materials by value, remaining materials to be grouped as others with the total quantity and amount. Step 4 is verify and fill, cross-verify each material's quantity, rate per unit and amount with purchase invoices and GRN records, assign category, whether it's a raw material, process, stores, and of course unit of measurement, and then fill in the B2A annexes. On the right-hand side, I'm also writing what to fill with all these records. Again, I'm not repeating. We are all qualified cost accountants. It doesn't need introduction here. The raw material, process, stores and spares, packing material, finished goods purchased, semi-finished goods. So these are the category column which you will be filling by the source document which I have shown in on the left-hand side. So this is where we do that. And now in the next slide, which I'm putting up, let me put up this on the screen right now. Input-output ratio. So this is important. In some of the companies where we are auditors, in every audit committee, the people have been asking that what is the input-output ratio, and then discussion takes place for 10-15 minutes internally between the company about why the ratio deteriorated or it increased. So what is the input-output ratio? Again, material consumed plus WIP divided by production output is input-output ratio. What it means, it shows how much input material is required to produce 1 unit. Lower the ratio, higher the efficiency. It's a very big KPI for the cost auditor to benchmark against industry norms. As you know, benchmark is something which is always discussed about. Now, the question which you have to remember is the ratio consistent with the prior year? Okay, sudden increase, then it's a higher wastage or maybe pilferage. I hope that you are understanding the type of the type of analysis we are able to make with these numbers and able to comment. Does the ratio match the technical sheet or bill of materials? Bill of materials had already defined what is going to be input-output ratio. Does it match with it? Has any change in the production process caused a shift in the input-output ratio? Is the ratio in line with the industry benchmark? And is abnormal loss or process waste being correctly accounted in B2A? Importance in cost audit need not be underemphasized. It helps detect inflated material and common mistakes in cost records. It validates whether the cost per unit in B1 is reasonable and justifiable. And again, you can take a screenshot of this slide as well, because you can probably talk about it to your clients, that this is where the input-output ratio is important. A ratio significantly above industry norm is a red flag requiring detailed investigation again. So you have to, and if you see the CAS 6, our cost accounting is standard 6, material cost compliance, actual consumption versus standard BOM. So it supports that as well. Now, the next slide, I'll give you the, probably you can just take a photo of this and keep it with you as your research data. We have got a standard input output ratio of commonly accepted benchmark range. I sincerely hope that this becomes useful to you in your practice and your interaction with the client, because this is a question which every client asks, that whether you as a cost auditor will be able to benchmark my cost. And of course, we cannot, honestly. It's not part of our mandate to do a benchmarking. But for our own consumption, this is our own research, that industry-wise, some of the industries, not all, cement, steel, aluminum, copper, sugar, rice, edible, uh, edible oil, PET bottle, pharmaceutical, paint, ceramic tiles, bricks, textiles. I have given you, the product-wise benchmarking. So I've also tried to give you, some of the remarks you might like to use it. What kind of process it is. I understand, Mr. Ghosh, you have mentioned a remark that it would be more useful if it comes from the institute. It is equally useful if it comes from an experienced cost accounting firm like us. So, and since this presentation is also being done by the institute, please take it as a that institute is very much with us in this kind of and every webinar or every technical webinar which institute organize across India is and the purpose of that is only to educate the CMA members with the better information. So this is of course not part of your cost audit records. This slide, this is not part of your annexes. This I have given you more as a value addition exercise which you can undertake while doing the cost audit. Now, the again, I have already spoken about it, but then I will repeat this, that how materials must be classified and disclosed by nature, by traceability, by source, 5% materiality rule, the others bucket, and the self-manufactured materials. So, this is how you can classify the material and disclose it. The next slide I put up on the screen is part B2A reconciliation. If I were to identify the single most important audit procedure for next B2A, it would undoubtedly be reconciliation. Okay, because this is not if there is a reconciliation, then our reporting is correct. Good cost audit is impossible without reconciliation. Every quantity and every rupee should flow logically from one record to another record. Stock identity, for example, first reconciliation. What are the areas of reconciliation? Okay. First is, of course, the inventory equation. Opening stock is purchase minus closing stock is equal to consumption. This equation should hold true both in quantity and value, not merely in aggregate, but material-wise wherever possible. B2A to B2. Next, verify whether the total value of materials consumed in B2A agrees exactly with the material cost appearing in part B2. Even a small difference should not be ignored. So you ask the question, is there any adjustment pending? Has any material been excluded? Has any write-off been considered? So because your B2A now becomes the base figure for the B2, as much as B2 quantity came from B1. So B1 was the base, similarly B2A will be. Okay. One of the most useful analytical procedure, now compare material consumed with the production quantity. Suppose last year 1.2 kg of steel produced one finish unit. This year 1.8 kg is consumed. Why? New product design, increased rejection, lower quality material, wrong recording, incorrect BOM. Okay. This ratio often reveals operational inefficiencies. Never depend solely on the ARP summaries. Cross-check with your stores ledger, purchase ledger, cost records, BOM, production records, financial statements. I cite one practical case here. During one audit, we found that material consumption exceeded purchase plus opening stock. Initially, management believed sap extraction was incorrect. After investigation, we discovered duplicate consumption entries created during system migration. So without reconciliation, this error would have gone unnoticed. Now the question which again I'll pause here and ask you gentlemen is that if quantity reconciles but your value does not, is that acceptable? Or is as a cost auditor or even a person who is maintaining costing records in an industry himself, if the quantity reconciles but value does not reconcile, is it acceptable? Are we acceptable to this situation? Quantities are reconciled, values are not reconciled. So in other words, what I'm trying to tell is that if the quantity is reconciled, can you say that forget it, values, let's forget about the value part. Can we have a situation that if the quantity reconciles, we can do away with the value reconciliation? Yes or no?
Unknown caller.
Yeah, correct. Both shall be reconciled. Absolutely. Yeah, very true. So, as people have answered, some of them have partly, but it's not only quantity. Because, why? Because quantity is a separate exercise. Quantity reconciliation and value reconciliation are independent audit procedures. Both should be completed. So you reconcile value independently and you can reconcile the quantity. Now let us discuss common mistakes in the actual cost audit assignments. These are the common errors seen in practice. We are at the nearly fag end of the B to A now. And I hope everybody is with me. This is a very detailed webinar, technical one, very, very useful for us. So common errors seen in practice of B to A, wrong classification. We discussed in past packing material you have included in that, though it was not a core packing material. Unit of measurement errors, one plant reports kgs, other reports metric tons. And then during consolidation, conversion is forgotten. So the total quantity become meaningless actually. BOM is not used. Many auditors verify only accounting entries. A better approach is to compare actual consumption against BOM. Any significant deviation requires investigation. In case of an import cost, we said frequently only invoice value is considered. However, landed cost should have everything: handling charges, customs duty, insurance, and all. So whenever unusual consumption is observed, please visit the production department. You'll be surprised to hear this, but then that's how it is, because when you find then you go to the source document. Very often, technical personnel explain issues far better than the finance personnel. Cost audit should always involve operational understanding. We always tell to my client that, yes, you might find me wearing this jacket, but we love to get into the factory, see the process, manufacturing process, meet the production manager. And that's the most exciting part of the cost audit profession, to be able to see what actually happens on the ground. Having discussed common errors, let us now distinguish between good audit evidence and warning signals. So I'm giving you a quick sight on what is red flags and green flags. Okay. Again, please take the screenshot of this. A professionally prepared B2A usually exhibits the following characteristics: consistent valuation policy, proper disclosure of major materials, perfect reconciliation, proper inclusion of landed cost, whatever we discussed. Okay. I mean, I'm just trying to summarize what we discussed in terms of the So we can understand exactly what can go wrong and what can be prevented by us. And in others category, most of the others category you are supposed to investigate because many times others often hide significant materials. Any change in valuation method require disclosure. Okay, consumption greater than availability is not possible at all. You can do that. You can check out that. Forex fluctuation should not distort material consumption. Okay, so understand the company policy and standards. So do not treat every red flag as a fraud. First of all, I'm not trying to say that something is wrong, so the company is doing wrong. Uh, you don't have to say that every red flag is a fraud. Most red flags simply indicate areas requiring additional audit work. And what we call is a professional skepticism. It means verifying, not assuming. So that's part of an auditor DNA, his nature is professionally skeptic. Let me rope you in again. Let me pause for a second. So what is the difference between a red flag and audit qualification? I'm asking a little technical question here. What is the difference between a red flag and an audit qualification? Can somebody write a couple of words? There is a red flag and there is an audit qualification. What is the difference between the two? I know people are thinking what to write. The difference between a red flag and audit qualification is, yes, Sunil writes red flag for future collection management. Red flag is before audit qualification is before, yeah. Yeah, I think you're mostly right. So the difference is that a red flag is an indication and audit qualification is a conclusion after investigation. Okay, so when you find a red flag, you go into deep and then whatever you come to conclusion is your qualification. So that's the major difference between that. So and now we move to the final technical annexure for today's session. Part B2B relating to utility consumption. So on the screen, as you can see, there's the details of utility consumed, the energy cost trail purchased and self-generated power, steam, water, and compressed air. So this is also very, very important. Gentlemen, we are all dealing with it in every cost audit report. They form the second largest component of manufacturing cost after raw material. And there's examples are easy, but as you see, the calculations is little complex. So what is utilities? Electricity, steam, water, gas, furnace oil, compressed air, industrial gases. But unlike raw materials, utilities are generally consumed immediately. So there is, we don't talk about inventory of utilities, okay? Yes, if you're having a power plant, you have an inventory of a coal, but you don't have an inventory of the steam. It just produces and gets consumed or gets wasted. So therefore, measurement becomes extremely important. So what is an objective of B2B now? So again, I'm no more on the B2A and B2B rather than B2 because these two costs will go up to B2 later on and then we'll analyze that also later. So objective of B2B is to capture quantity, value, rate, source, and consumption. So utilities may be what? Purchased, it could be self-generated, or it could be both. Example, power, you can make the power, you can buy from the grid. So the auditor should understand the complete flow. For example, electricity generated in a captive power plant should not simply be valued at market tariff. Its cost should be computed based on actual generation cost. This requires verification of fuel, labor, maintenance, depreciation, operating expenses. Therefore, B2B is far more analytical than it appears so. You will have a power plant cost sheet itself. So now let us understand every item in detail. I put B2B again on the screen, details of utilities consumed, name of product, HSN code of, not the utility, HSN code of the product which you are manufacturing. And the type of utility. So let me take you one by one. On the right hand side is our annexure B2B, and the left hand side you will see what is the structure of this B2B schedule. So type of utilities: power, fuel, steam, water, compressed air, similar inputs. So again, don't club different utility types into one line. You just don't call it utility. It's a different utility. You have to classify it separately. Quantity again could be outright purchase, it could be generated, it could be transferred, and a quantity which is actually used in the production. And to consider the same from SAP records or SAP dump data and utility invoices whenever you are buying directly. So those who are buying only electricity and nothing else, then simple bill from the electricity, GSAB, MSAB, etc., they become your. And the utility identification ensure that all major utilities, power, steam, water, etc., are included. Unit of measurement, you know that every utility has a different measurement: kWh, MT, KL, SCM, NM3, and so on. And rate per unit, purchased, bill rate and on generated and build up cost of generation and compare against the market norms. So this is where we talk about the type of utility. Let me give you a practical example here again. Suppose purchased power is 8 per unit kWh. Captive generation is, let us say, 5.40 per kWh. Management may assume captive generation is always cheaper, but ask that has depreciation been considered? Has maintenance shutdown cost has been included? Has auxiliary power consumption been deducted? Have transmission losses been considered? And also whether the interest on the capex which was incurred in setting up a power generation plant, that has been considered. So these 4 or 5 costs should be added to that 5 rupee 40 paisa, and then that should come below the purchased power of 8. And then also purchased power of 8 for not only last month, you should see the average of last 12 months, because the grid also keeps on giving you a volatile rate of purchase. So whenever auditing utilities, ask the management that have any new boilers been installed, as a fuel type has changed, as electricity tariffs have changed, has renewable energy been introduced, have you introduced any windmill or solar panels, has any government subsidy has been received, has production shifted between the plants, and so this answers again offer cost trends into the utility. And secondly, always compare utility cost per unit on Y-on-Y basis, year-on-year basis. If production remains constant, but power consumption increases by 20%, let us say, just as I gave you the example of the raw material, then you have to investigate, and the possible reasons, it could be aging machinery, poor maintenance, increased idle running, process change, production mix change. You see, for example, in our audit, one of the audit, electricity consumption increased by almost 15%. So management initially attributed to tariff revision because tariff had gone up, so cost has gone up. However, our analysis showed that tariff had increased only 3%. Whereas further investigation revealed that frequent machine breakdowns causing repeated startup and stop operations had consumed more power. The additional electricity consumption was due to operational inefficiency rather than the tariff increase. So this observation eventually helped management improve production planning. That is where production planning. See, the impact of this start and stop was that production planning was defective. And it had nothing to do with the utility plant or a power plant. So this is how the cause effect works actually when you start analyzing your cost intelligently. And that is where cost audit creates real value. It's not merely compliance. So you would have thought that this is a compliance, but as you can see, just now, I give you a practical example. This very statement will give insights into the bad production planning probably. Let me ask you a question here. Should utility losses always be included in the product cost? Should utility losses always be included in the product cost? Yeah. Deepak, normal losses. Sudhir says, okay. Any more answers? Let's have more participation. Yes, Jyoti. Right. Find type of loss, then record. Okay. Mr. Ayyawar says it's a normal loss. Yeah. Yeah. Okay. Well, all of you are right, almost. We don't include all the losses in the product cost. Normal losses form part of the cost of production. Abnormal losses should generally be identified separately and not loaded onto the good production. Now, having understood the structure of utility consumption, so people are aware the way in which I conduct we first justify the statement, get into the details, extract the statement, and then we transit into, we understood the structure of this utility consumption. We shall next discuss the practical audit mistakes, green flag and red flag again, and finally conclude today's webinar with the key takeaways and an interactive discussion. So, utility consumed sourcing and verification of framework. Again, please feel free to take a screenshot of this. We have 4 types of utility: purchase utility, captively generated, mixed sourcing, and other modes. What could be other modes? On the last, it's a free of cost inter-unit transfer by product utility, inter-unit job worker agreement and transfer basis, notional valuation method, no double count with supplying receiving unit, allocation basis to be stated. So in case of other modes of utility. In case of a purchase utility, you are simply taking supplier tax invoice or a contract tariff rate per unit in case you have a long PPA, or GRN, or reconcile invoice units to the meter. It's just like your house electricity bill. Whatever shows the units in your house, you should reconcile every month. You should see your electricity bill and compare the units consumed rather than the rate. So it will give you an idea that how much, I don't know, how many ACs you are running in your house, or how many times your washing machine ran in the house, and so on. And same thing applies to the factory as well. Similarly, captively generated, most of the companies have their own captive power plant. They will have a coal-fired, so there will be a boiler and a whole lot of power plant operations. Of course, the fuel to output ratio and all these things, you can definitely collect it from the plant manager. And the power plant should be having its own independent cost sheet. Mixed sourcing is when your power plant generation is not sufficient, you have to purchase from the grid as well. Or sometimes if you have a renewable energy plant which cannot be relied upon on 24/7, you also need a grid supply. In that case, you'll be doing a mixed sourcing. So even actually by looking at the sources of utility, you will be able to know a lot about the company, which we can do that. Now, I've given you a little dummy extract of the power cost. You can see how the power cost has been on generation and purchase. Let us first understand the on generation section. A company can generate power through multiple sources. Gentlemen, this is a very important slide, as a matter of fact, because this can be sometimes a very significant game changer for a company. A company can generate power through multiple sources, as I said. So you have a thermal power plant. What is thermal power plant? You manufacture the power through coal as a utility, then diesel generators. Then you have a CPP-WHRS, that is captive power plant waste heat recovery system, and solar power, and of course wind power as well. So for each source, we capture both the power generated and the associated cost. The quantity of power generated is generally extracted directly from SAP or the company's operational records. The cost components, such as fuel consumption, stores and spares, repairs and maintenance, salaries and wages, depreciation, and other overheads are taken directly from the company's cost center-wise trial balance. And in case there is no cost center-wise trial balance, then there are production records or units which are recorded by the company. One important point to note is that power sold to external parties and power billed out to other group units is deducted from the total generation. So you generate a total power plant, and let us say you have 4 or 5 other group companies, and then you are also selling it to, because you have an excess power, so you are selling it to external person. In that case, you have to deduct it to arrive at the power for that particular cost. Since this power is not available for the company's own operations, it should not be included while calculating the internal power cost. So after making these adjustments, we arrive at the net power generated, which is mentioned on your slide on the screen, which represents the actual power available for the company's own consumption. The total net cost is then divided by the net units to determine the cost per unit, cost per kWh for each source. Now let us move to the purchase section quickly. Apart from generating power internally, companies will buy it from State Electricity Board, Indian Energy Exchange, solar power suppliers, or power billed from other group units. So the quantity can be obtained either from SAP or from electricity invoices. Then let's go to power mix and power distribution. These tables serves as a summary of all power sources. As you can see, I have put the TPP, DG, CPP, solar, etc. The net units and the net value from the previous 2 tables which we showed are consolidated here. Once all sources are summarized, we calculate the weighted average power cost. So total power cost divided by total power unit is your. So what we have done here is that we had a different cost per kWh from various sources. We totaled it up and we arrived at the weighted average cost of the power for our company. And that's the rate which you will apply to your product cost. Because here it's not that you are only using one power for one product. You are combining all the power. And so this is how your rate will be taken. Of course, this is obvious, it need not be emphasized, but on the right hand side, I have seen the power distribution I have shown, product process 1, 2, 3, and then within the process, product A, B, C, D, E, F, G. So, and the ratio of allocation and apportionment is, of course, as per our cost accounting standards. The power distribution table shows how the total power consumed is allocated under the product. The most important audit checkpoint in here, what should be? Is to ensure that power mix reconciles completely with the power distribution. So whatever you're showing in one generation, it should have been already distributed to the product. So this means that total power units generated and purchased is equal to total power units consumed. And total power cost is equal to total power cost allocated. So nothing should remain idle. In other words, both the units and the value should match exactly. Of course, I need not tell you why, because electricity cannot be stored as inventory. It should have been consumed. So it should be loading on the product cost. So to summarize the overall flow, calculate the cost of generated power, calculate the cost of purchased power, combine the both, arrive at an average unit, and allocate it among the product. Now the slide, next slide, which I am taking you people into, efficiency ratios of power, fuel, and water efficiency. As you can see, the type of utilities and units I have shown in on the again screen, which you can very well take it as a reference point for your future audit. in each one I've said that what should be the query points to auditor. For example, you are writing that is utility ratio consistent with the prior year? Does kWh per MT match the technical energy audit report? Has the product mix changed? Captive power generation cost versus grid power? Is idle shutdown power cost included? Must be excluded from product cost. So you should not include the shutdown power plant. And then importance in cost audit is that it detects inflated utility cost. It validates your case 8. Now CS 8 is our cost accounting standards for cost of utilities. It helps auditor benchmark against similar plants, industry norms. Sudden increase in ratio could be possible equipment breakdown or energy theft, as a matter of fact, and forms basis for energy efficiency recommendation to management. So again, every report, I am starting from my very first webinar of audit to advisory. Every report puts you into an advisory role. And if you are able to analyze this properly, you are definitely adding value to the cost audit. And now, common errors which we are generally seen in the practice, we will briefly discuss that. I put it again on the screen. You can take a screenshot. This is one of the common mistakes is that we club purchase and self-generated utilities together. Okay, so this should be avoided. Then why it should be avoided? Because generation had so many other costs like labor, depreciation, repairs, etc. Whereas generation was only a single bill. Different utilities sometimes are reported as one. You combine all the utility into one cost and show that this is your utility cost. But as a cost accountant, you are supposed to actually divide all your utilities into various types of utilities and signify and underline the importance of each of the utility to the organization. Standby plant cost ignored. Many companies maintain DG sets or standby boilers, even if these operate only occasionally. The cost cannot simply disappear because the equipment was rarely used. Sometimes you mix up environmental cost with utilities. Effluent treatment plant is a common thing with almost all chemical plants and pharmaceutical plants. So effluent ETP expenses, pollution control cost, carbon credit income, environmental compliance costs are sometimes adjusted against utility expenses. This should normally be disclosed separately. Utility allocation without technical basis. Suppose one factory manufactures 3 products. Electricity cost is simply allocated based on production quantity. But one product uses heavy machinery, while another requires manual assembly. The allocation becomes inaccurate. So wherever possible, utilities should be allocated using meter readings, machine hours, and technical consumption norms. Again, I would love to give you a practical example, but I think this is all known to very well to everybody for the paucity of time, since we are supposed to conclude at 5 o'clock or it's carry on till 5:30. Okay, fine. My colleague says we have more time. So practical example, consider 2 manufacturing departments. Department A consumes 70% electricity. Department B consumes only 30%. Then if electricity is allocated equally, product cost will be distorted. So you have to go as per the kWh of the meters. And what should the auditor do if sub-metering is not available? Can I ask you here a question? I mean, I went on saying, read the meters. But what if the meters are not available? How the auditor, what should he do? Can somebody quickly put it on the chat? If you don't have meters, sub-meters, I mean to say, main meter is there in the factory, sub-meters are not available into the plant or a cost centers, what will you do? Any answer? Atish says based on area allocation. Amit says based on quantity produced. Sunil says consumption by every machine. Consider as a production as a basis. Rakesh, based on Domain says based on a consumption per unit. Machine running hours, Deepak says, you're close to it, yeah. So answer is that uh, obtain the technical allocation basis from the engineering department. Please involve him. Evaluate its reasonableness and ensure consistency with the previous years, and document the rationale in the audit working papers. So in audit working papers, after discussing with the engineer, take it in writing from him that this is what he feels to be the technical basis. Make it as a part of him. But of course, it cannot be allocated on the our accountant definition on the gross block or the number of people, etc. It has to be technical evaluation. And most of you have answered it very, very correctly. So here again, I'm taking you to the green flags and the red flags of audit. We have, you can again take a screenshot of all green flags and the red flags as auditors gain experience. They begin to identify the patterns. Certain schedules immediately indicate that the costing system is robust. Others suggest that additional audit procedures are necessary. Believe me, when you are involved so much into the cost audit, the way in which I am putting up in this webinar series, you are invaluable to the client, indispensable and irreplaceable, if every one of us follows the same practice. Green flags, let us first look at the characteristics of a well-prepared utility schedule. Separate disclosure for each major utility. As I said, clear distinction between purchased and self-generated utilities. So you can just take the screenshot of it, and it's most of them is something which I've already mentioned in my talk. I am repeating more because it's a technical webinar teaching session and a learning session for the new as well as present practicing CMAs to look at a different kind of a mindset which you have in the cost audit. In the red flags, I'm giving you the warning signs, sometimes companies include interest on loans used for captive power plants. So finance cost, again, we are going back to our cost accounting standards that what to be excluded and what not to be including. Similarly, idle capacity cost gets loaded on the production. And transfer pricing issues, for example, that also happens here when utilities are transferred between related units. You have to ensure that the transfer price is based on cost principles and is consistently applied. Otherwise, segment profitability will be misleading. Never conclude that a red flag. Again, my humble request, please don't conclude that red flag is a fraud. A red flag simply indicates that the further audit evidence is required. The role of the cost auditor is to verify, analyze and conclude objectively. Let me ask you a question. Can a significant increase in utility cost ever be acceptable? Can we accept a very significant increase in the utility cost? Is it acceptable and should be part of the cost of product? Mr. Shankar says no. Significant increase in utility cost cannot be acceptable. Any other answers, please? Rakesh says yes, it may be. Ramkesh says no. Padma says it should be non. Prafulata says no. Sunil says yes, if it is because of a new machine. Jyoti says depends. Amish says if it is due to units increase, like hike in electricity. Wonderful. So all of this, as a matter of fact, example, yes, but it should be acceptable, first of all, because see, utility cost is not something which you can't reject. It has happened. You consumed and utility cost has incurred. But why it has gone up? You please analyze. It could be increase in fuel prices. You know what happened currently? We had the oil price increase so much. New environmental compliance requirements has put a levy or a cess on that production of a more energy intensive product mix. So you are now, see, your one utility report takes you that the company has actually changed the product mix and it requiring more energy. Then the planned maintenance shutdowns which happened. Now, if it is a maintenance shutdown, of course, it has to be part of the cost. Change in manufacturing technology again, requiring more power. So the key is whether management has adequate documentation to support the increase. So again, I would like to put a caution here that we are discussing all these reasons, cost auditor is not here to question the management why this happened. He is only trying to find out an evidence to the sudden increase or decrease and finding a report or a supporting document for the cost incurred. I'm not at all suggesting that he goes say, come on, management, Mr. Client, what happened? How come your utility cost has gone up so much? I mean, client knows about it. Client has exactly known that why his fuel prices went up. But when it comes into the cost audit report, your duty is to find out a document which is supporting this. If documents are not there to support it, then that is your red flag. And that is where you deep dive further. And then also you are not given any document, it leads to the audit qualification. That this should be very, very clear in everybody's mind. This brings us now to the end of technical discussion. So before concluding, again, as my habit is, those who are regularly attending, you are aware that we summarize today's key learning points. So it gives us two purposes. One is that it reminds, many times we keep on talking and then sometimes we forget the key takeaways. Secondly, those who join in between or those who had to leave in between, that links are broken. So we are putting up on screen again. So key takeaways, B1 and B2A. Just remember, we have not yet gone to B2, which is going to happen in the next week. But B1, B2A itself took 2 hours of session, which shows how important it is. So key takeaways in annexure B1, always prepare B1 on a HSN code-wise basis. Verify install capacity through technical evidence. Ensure production, sales, stock, and captive consumption reconcile. Analyze capacity utilization and investigate abnormal trends. Never rely solely on a manually prepared Excel options. After this takeaway summary, I will be happy to take questions. Annexure B2A, we talked about materials consumption. We have to classify materials correctly. Reconcile quantity as well as value, review input-output ratios, apply the 5% materiality rule independently, verify landed cost for imported materials, compare consumption with BOM and production. And in annexure B2B, we understood the utilities part of it. We re-emphasized that report each utility separately. Distinguish purchased and captive generated utilities, verify utility quantities through authentic records, review utility cost per unit, understand technical allocation methods, investigate abnormal consumption records. Remember one principle, my dear CMA friends, that every figure reported in the cost audit report should be traceable, reconcilable, explainable, and supported by sufficient audit evidence. So cost audit is not about compiling numbers. It is about understanding operations. It is about analyzing efficiency. It is about adding value to the management. And ultimately, it is about enhancing the credibility of cost information. Compilation is the job of your client's costing department. Your job is much more than what and it includes what I narrated just now. With these thoughts, let me conclude today's technical session. I'm happy to take a new few questions if WRC has a time at its disposal. So in coming 2-3 minutes, if you don't have any questions, I'll request Pujanka to conclude and summarize.
Yes, sir. We will wait for the 2-3 minutes, sir. Any other questions?
While people are writing only thank you and not raising questions, I will again repeat that every cost audit assignment should always be viewed as an opportunity to create value for the organization. I encourage all members to continue studying the cost accounting standards, cost audit rules, guidance not by the institute, and to remain updated with evolving industry practices, and of course, attend such webinars. So professional excellence comes through continuous learning and practical application. I thank you once again, everybody, to attend this session and so actively. And I look forward to next Thursday, where we are going to discuss most important statement, costing statement D2. And we have already created a basis for this by discussing all previous pro forma. And now we are all mentally prepared to prepare our B2, analyze it, and add value to this D2 statement. Thank you very much once again.
Sir, there is one question
Okay.
from Rakesh ji. That is, how can we allocation of secondary overhead?
Yeah, so we are coming to overhead allocation and apportionment in the next session, B2. Our B2 will cover all the cost of goods sold, every element, including marketing, selling, and all. There we will be doing this as well.
Sir, one more question. What about the transformer loss?
Transformer losses in the power plant. So just as there is a, so see, transformer is a capex expenditure, and when there is a transformer loss, this basically you write off. This is not a production loss.
Thank you, sir. One more question. It's right to use asset amortize is cost item or otherwise?
It is a cost item.
Okay. Sir, one more question. What is the best way to review capacity utilization of electronic components?
See, when a company manufactures electronic components, it is just like any other product manufacturing. So first of all, you have to decide what was the installed capacity of the these electronic components when you set up the factory. Let us say, take the example of a Dixon Technologies, which is in manufacturing mobile phones. It would have set up a capacity, and when the actual production happens, you compare with this installed capacity and you arrive at the variance. There is no specific difference between electronic components or chemicals or steel or anything. The capacity utilization is always in respect to the installed capacity utilization.
Thank you, sir. I think there is no other question, sir.
All right.
Shall we
Thank you.
conclude, sir? Yes, sir. On behalf of the Professional Development Committee of the Western India Regional Council of the ICMAI, I express my heartiest gratitude to Dushan Dave, sir, for the informative and wonderful sections on the cost audit, sir. Thanks all the participants for participating. Our next and last session is on next Thursday. I request all the participants to kindly join. Thank you. Now we will officially conclude the session. Thank you very much.
Thank you.
Thank you, sir.
Thank you.
Yes.
Bye-bye.